Realty Income, or the famous monthly dividend company, is down by over 15% since last October, and its dividend yield is close to the highest levels of the last 10 years. This REIT is highly regarded and one of the most popular choices amongst dividend investors. But why is it down? And does the high dividend yield mean that they are in trouble? Or is it a good buy chance? In this video, I will analyze what's behind the crash and if this could be a good buy opportunity for long-term investors. I am Florian and this is Cashflow Maniac. Thank you for joining me today. Last year, Realty Income did underperform the S&P 500 by half with 12.7%. This is still not a bad performance when we remember that the long-term average return is, depending on what index you use, between 7% and 10%. Over the last 10 years, it actually looks quite similar, with Realty Income producing 70% returns, while the S&P 500 did return almost 250% in total returns. And this is total return, so it already includes all dividend payments. They have actually been on par with the index until roughly 2020, but since then they have been going mostly sideways. If you don't know what Realty Income does, let me break it down real quick. But I assume that most of you know the company already, so I'll keep it very brief today. The Realty Income Corporation is a triple net lease REIT that specializes in acquiring and managing high-quality commercial properties. They were founded in 1969 already and primarily invest in freestanding, single-tenant properties leased to leading retail and industrial businesses like 7-Eleven, Walgreens or Home Depot with long-term agreements. They have a very diversified portfolio where no single client is responsible for an overwhelming share of their business, which makes them quite secure. For a couple of years, they are also trying to diversify more towards Europe. As of today, Europe makes up a still small but growing 14.6% of their portfolio, split over 6 different countries. So, when we consider that a REIT is always only as good as its tenants, this diversification is a big strength in my book. For example, their second biggest customer, Walgreens, is really struggling right now, which could pose a risk for Realty Income. Because if Walgreens can't pay its rent anymore, Realty Income is losing money. But even though they are the second biggest tenant, they only make up 3.3% of the total portfolio. So even if we assume that they stop paying the rent altogether from one day to another, the effect is still manageable. Their top 5 clients together only make up 14.3% of their rent. This is even more important when we consider for whom Realty Income is a good investment. And that is dividend investors who are looking for a steady, stable and secure passive income. It also helps that Realty is a triple net lease REIT. But what does that actually mean? In their company presentation, they explain that this means that their clients are responsible for most expenses like property taxes, insurance, utilities, and even maintenance. When combined with the long lease terms of up to 30 years, this gives a very stable and, most importantly, predictable income stream for the company. At the moment, the average lease term is 9.5 years, and when we look at the schedule, we see that in the next few years, not many of their leases will expire. They are also not leaning back and relying on the same properties forever. In fact, while they originally focused solely on retail properties in the US, they have since expanded their portfolio to include industrial properties, international ones, and more recently, gaming and data centers to their assets. One example for this is the Encore Boston Harbor Resort and Casino that they acquired in December 2022 and that has a lease term of 30 years. But especially the data center sector is where the company sees a huge potential in the coming years. Here, the demand is expected to grow much quicker for the next years compared to the general commercial real estate market. What is also interesting is that the initial investments is not the end of the line as with typical real estate. Instead, they have the option to start with a lower investment and a lower data center capacity and expand this further if their clients require additional capacities. So instead of developing a whole new property, they can just expand the existing ones, which is much cheaper. But they are not owning this by themselves. For this data center business, they have formed a joint venture with another REIT, digital realty trust, which is specialized in this kind of data center properties. And what I found especially interesting is that one of their major competitors here, Equinix, is actually stating them as their biggest competitor in this space. This all looks very promising. So why didn't the stock do much for the last 5 years, and why are they down by 15% since last October? Well, for once, REITs are affected by interest rates and risk-free returns because, first, they need to take on debt to finance their real estate acquisitions, and second, the bond yield affects the risk-free returns for investors, which hurts dividend companies in general. And when we look at the yield of 10-year US bonds, we see that since last September and October, the bond yield has also increased by 1%. So, when investors can get a virtually risk-free return of 4.5%, many are actually considering why they should take on the extra risk that a REIT has for a measly 1.5% of dividend yield. In terms of interest rates, they write here on REIT.com that increasing interest rates are often driven by economic growth that may support the growth of REIT earnings and dividends in the future. Research shows that REIT returns have generally been positive and have often outperformed the S&P 500 in periods of rising interest rates. And when we scroll down a bit, we also see in this graph that in the last 30 years, REITs have more often than not produced positive returns when interest rates were rising. And not only that, because when interest rates and yields fall, dividend stocks tend to do quite well. So if you are a long-term investor and believe that the currently quite high interest rate and bond yields will fall again, it might be a good time to lock in the currently quite high dividend yield and benefit from a rise in stock price when the time comes. And when we look at the fundamentals of the company, we see that even though the stock price went only sideways, the revenue, net income and free cash flow all went up very nicely in the last 5 years. Only the EPS did go mostly sideways. This resulted in a compounded annual growth rate for the last 5 years of 28.4% for revenue, 25.4% for free cash flow, but a negative minus 3.9% for EPS. But the most important metric for REITs is actually the fund from operation or FFO and the adjusted fund from operation or AFFO. And when we look at the latest quarterly report, we see that they could also grow both of these metrics very nicely last year from a bit over 2 million for the first 9 months in the last fiscal year to 2.7 million in the current one. In their quarterly presentation, they even show that on average, they grow their AFFO by a bit over 5% per year. The only time period that really stands out here is the financial crisis in 2009 and 2010. But despite this growth, Realty Income still has a very good credit rating of A3 from Moody's and A- from S&P Global. This is still well within the investment grade rating. At the moment, they have a net debt to adjusted EBITDA of 5.4 times, and for a REIT, these values are actually quite good. What is important to note here is that next year, a large chunk of the debt needs to be refinanced. And here, the high interest rates will have a negative effect if that means that the company has to refinance this at higher rates than before. So we need to see how the management will handle this. This year, the amount of debt that is due is rather low, but this is something that investors in the company should keep in mind for the next 2 years. When we look at the shares outstanding, we see that there was a significant increase of shares outstanding in the last 2 years. This looks kind of scary at first, but there is a reason behind this. Realty Income had a couple of big acquisitions in the last years, namely the merger with Spirit Realty Capital and the acquisition of 415 properties from the EG Group. This has brought the share dilution in the last 5 years to a whopping 21.3% annually. But because of the special circumstance, I would not assume that this is the rule, but rather an exception. Of course, the monthly dividend company is paying a dividend, with a current yield of 5.8%. This yield is very close to the highest levels of the last 10 years and was not achieved very often. Usually, it rather sits between 4 and 5%. They could also grow the dividend with a CAGR of 3.6% over the last 5 years, and this is nothing new. because they are a member of the dividend aristocrats and have increased the dividend for every year for the last 30 years. And despite this long growth streak, their AFFO payout ratio is still at 75%, which is roughly in line with the sector median. So there is no sign that this dividend is at risk. When we look at the current valuation, the price to AFFO is at 12.9, which is a bit below the sector median of 13.6. And the same is true for the price to FFO of 13.1 compared to the sector median of 13.6. Even the current dividend yield is not only above their own history, but also above the sector median. And if you are new to REITs, I am not using the usual metrics like PE ratio or price to sales ratio for REITs because this leaves out half of the picture. The earnings or sales just don't reflect the real estate business very well. When we look at the Golden Growth model that estimates a fair value of companies based on the dividend payments and dividend growth and assume a rather conservative WACC of 8% and also a rather conservative dividend growth of 3.5%, I come to a fair value of around $66. And even when I include my margin of safety of 20%, the fair value is still at around $53, which is roughly the share price today. So overall, the current valuation seems to be quite cheap. But of course, the market is always trading the future. So what is the expectation for the company for the next years? The 19 analysts that cover the company are actually quite bullish. They estimate a one-year price target that is on average around 11% above the current price. The lowest expectation is roughly the price today, while the most optimistic of the bunch even see an upside of 21%. And when we look at the FFO estimation in Seeking Alpha, we see that the funds from operation are expected to grow by 3 to 5% over the next 3 years. This is not too huge, but still higher than last year. And we should not forget that Realty Income is not a growth company, so we should not treat it like one. Last but not least, before I sum this up and come to my conclusion, let's also compare them to some of their closest competitors. And if you find this video interesting, please hit the like button and subscribe to the channel so you don't miss out on my next analysis. As a small channel, this really helps me out a lot, so the YouTube algorithm pushes this video to a larger audience. Thank you very much. So for today's peer comparison, I choose the Simon Property Group, Kimco Realty Corporation, Regency Center Corporation, and to also have a comparison with data center REITs, even though this is just a very small part of Realty Income's business, Equinix. And from a total performance point of view, Equinix did have by far the best performance. This is not surprising when we consider the huge growth in demand for data centers in the last years. But Realty Income did have the second best performance of this group and the best one of all retail REITs. They are also the ones with the currently highest dividend yield and, again after Equinix, the second biggest dividend growth. But the dividend yield of Equinix is also by far the lowest of the group, so they have a bit of catching up to do. So overall, I think that the company is very appealing at the current valuation. With their strong balance sheet, they are in a great position to not only pay, but also to grow their dividends for years to come. And they have also managed to reinvent and adapt their business models in the past, and with their focus and joint ventures for data centers, they are trying it again. And while they might not grow as quickly as others who solely focus on these growth topics, their diversification makes them more resilient. So if you are looking for a steady and stable dividend income, the currently high dividend yield is actually a good time to lock in a position in one of the most mature REITs. But that is just my opinion. What do you think about the company? Do you like it? Or do you have any alternative that you like even better? I would be really interested to hear your thoughts down in the comments below. And please, before investing, do your own research and only use this video as a starting point for your own analysis. And guys, I'm trying to be fully transparent about my investments and my investment strategy on this channel. That is also why I share and update my portfolio on a regular basis. If this sounds interesting to you, be sure to check out my latest update right here. That being said, thank you so much for watching guys, and see you in the next video.